I think we've talked before that I coined the phrase bond vigilantes back in the early 80s.
Right.
And they're back. They kind of were asleep for a while because inflation really wasn't much of a problem. And the bond vigilantes' job is to take law and order into their own hands in the capital markets and the credit markets if they feel that fiscal and monetary policy makers are out of control. And I think the bond vigilantes, my guess is they feel pretty comfortable with what the Fed's been doing. They've been laser focused on bringing inflation down and raising interest rates, and that's obviously hurt bond investors. But at some point, that will be good for the bond investors. It's the fiscal side, I think, that's got them really riled up, and that's where we are seeing this recent spike in the rates.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Welcome you to a special interview today. You'll see I've got a different background. I am recording from the road while at Vid Summit, which is the world's largest gathering of YouTube creators. But the content creation doesn't stop just because I'm on the road. So we're here bringing you another interview this week, a great one with Ed Yardeni. You know him as president of Yardeni Research. He puts out some of the best charts and research, particularly on markets in general, but certainly what the central banks are up to. I interviewed Ed a couple of months ago. A lot has happened since then. So I'm very excited to get this update from him as where he is in terms of his thoughts on, does he still remain a bull under these market conditions? Does he still give odds of a soft landing going forward? Definitely want to talk with him about what's going on in the bond markets. Ed, thanks so much for joining us today.
My pleasure, Adam.
All right, Ed, like I mentioned, there's a lot to talk about here.
Sure.
Why don't we start with what's going on in the bond markets? Because I think that's really been the big news
Absolutely.
of the week. This week, the week that we're talking, the 30-year Treasury hit 5%. 10-year Treasury is getting close to that. In many cases, yields are higher than people could have imagined a year ago. What's going on? What's driving this increase in yields right now? And how much further do you think it could go?
Well, the increase in yields that we've had since the low in 2020, when it was 0.52%. Now it's, as you said, the 30-year is already at 5%. The 10-year is moving in that direction. It's still kind of below 4.8% while we're talking. But I think what's going on here is that the bond market suddenly cares about the supply-demand dynamics of the Treasury bond market. In the past, supply and demand never really mattered much to the bond market because the deficit typically widened during recessions. That's when we had our most increase in the supply of treasuries relative to demand. But meanwhile, private sector demands for credit were drying up in recessions. The Fed switched from raising rates to lowering rates during recessions. And this time around, though, it is different. What's different this time around is that the deficit's widening. And part of that is because of interest rates driving up the interest outlays of the federal government. And so that's become a concern to the bond market, especially since Fitch Ratings downgraded US Treasury debt from AAA to AA+. I mean, nothing really changed in terms of the ability of the federal government to pay. I think what that downgrade brought home to everybody is that, we've got a serious problem with this deficit. It's been widening. We've got a lot of debt. And as interest rates have been going up here, more and more of the outlays are going to just to fund the interest payments. So I think it's a supply-demand issue. The bond market is repricing the yield to a level that will bring back demand or equilibrate or rebalance the bond market. And I'm hoping that's somewhere around here, around 4.75%, 5%. The risk is that it's not high enough, and we're going to go still higher. In some ways, we've sort of normalized the bond market. We're back to where we were before the great financial crisis, when the yields were between 4 and 5% for the 10 years. So now we're between 4 and 5%, obviously closer to the top of that range. But I'm not sure that the economy can withstand much more than that. I think it can handle 4 to 5, But higher than that, I think we're going to have some problems.
I'm smiling, Ed, because as a good interview guest, you went right to where my next question was going to be, which
Sorry
is
about that.
No, it's great. Which is, can the economy actually handle these rates? So you just said 4 to 5%. You think the economy could handle that? Now,
it has been handling it in some ways. I mean, I've been talking about a rolling recession, and the economy certainly has had recessionary developments, but they've been going through different sectors at different times, as we discussed last time. And on balance, the economy has handled it well, as have consumers. But go ahead. I'm sorry I interrupted you.
No, okay. You're taking into the territory I want to take it into, which is, the economy, we can say had been habituated to much lower rates.
Correct.
Right.
Yeah.
Some might even say addicted to them. Right.
Yeah, absolutely.
So for some period of time, it can absorb the rise in rates that we've seen over a relatively compressed period of time. Right. Now, this brings up the question of the lag effect, right? Which is, can it sustain these rates because it, quote, has been so far? Or does the lag effect, with enough time, does the lag effect break something and bring things down here? I guess first, just to clarify your general assessment, do you think it could sustain at 4 to 5%, or do you think at 4 to 5% for long enough, things start cracking?
I don't know for sure, but I think the odds right now, based on my kind of study of the history, is that the economy can withstand 4 to 5%. The period you referred to was the period between the great financial crisis and the great virus crisis. I refer to that as the new abnormal. As you said, interest rates were abnormally low. There was quantitative easing, and money was basically free. It was remarkably cheap. And now, within a matter of 3 years, we've seen the bond yield completely reverse the drop during the new abnormal back then. And now we're kind of back to the old normal. The old normal was 4 to 5% rates from 2003 through 2007. There's certain sectors that obviously are interest rate sensitive that have already gotten hit. Housing, for example, got hit really quite rapidly early last year as mortgage rates zoomed up to 7%. Now they're zooming up to 8%. But there are plenty of people who really want to buy a house, and sometimes it just takes them a while to get used to this level of interest rates and put the money together from relatives or from deciding that they're going to be willing to pay up more for a mortgage. So I think single-family housing may actually have bottomed. It's multifamily now that may be going into a rolling recession. The math just doesn't really work anymore. Rent inflation's come down dramatically. There's been probably overbuilding in the places where people are moving to the South and the West. And that's bad news for the economy. It's great news on the inflation front because we need rent inflation to come down in order to bring the CPI inflation rate down. And I think that's happening. But we've had a recession in the goods sector. People went on a buying binge once the lockdowns ended in 2020. They wanted to buy services. They couldn't buy services, so they just binged on goods. And by the time retailers were able to restock, because a lot of the merchandise got stuck in the ports, couldn't get transported on trucks, by the time the stuff arrived in 2021 and 2022, guess what? Consumers said, "No mas, we're going on the road. We're going to travel." And so there has been a recession in retailing, and they had to discount prices, and that's helped to bring inflation down. Now the consumers have swung to services, but there's evidence that the goods recession may be ending. The Manufacturing Purchasing Managers Index is still below 50, but it's been turning up the past several months. So rolling recession should be followed by rolling recoveries, and I'm seeing one in the goods sector. I'm certainly seeing continued strength in construction of manufacturing facilities. I think we're going to have lots of strength in infrastructure spending by the government, but the recession is definitely rolling into the commercial real estate market now, and that's going to be a multi-year recession in that marketplace, and it's affecting not just old urban office buildings, but every commercial real estate property that was financed at record low interest rates. If it's tied to variable rates or it's going to start rolling over into a new debt. The math just doesn't work with interest rates where they are now, and what's happened to tenants in some areas, and just the whole change in the economy. I mean, people are continuing to massively buy online, and that's affecting the malls, and we know that malls have been in some trouble. So I think the question is whether these rolling recessions can all add up into an economy-wide recession. I think the answer is yes if the consumer caves in, but the employment situation still remains pretty strong. I know the latest ADP number was weak, but the job openings are there. I think we're seeing some easing in the tightness of the labor market, but I think the labor market's going to continue to create jobs. I think wages are rising faster than prices, so I think the consumer hangs in there. I know the delinquencies are going up. We got auto sales today, and they kind of were flat. They're not taking a dive. You would think with auto credit getting tighter that people might be hunkering down. But all in all, it just looks like, I find myself in an interesting forecasting situation here. At the beginning of last year, I was arguing about a rolling recession rather than an economy-wide recession. Now I'm saying, well, that strength in the third quarter was probably a fluke, and things are actually going to slow down. But I don't think to slow down to the point of a recession. But look, it's not it's not 100% situation.
All right, Ed, great answer. I took so many notes because there's so many things you touched on that I want to dig into with you. Why don't we start with housing? And I definitely want to talk about the consumer too, because we're talking on a day where I think data just came out that showed that credit card spending really took a big dive in September, which may be an indication that the consumer household is beginning to really weaken here. But let's start with housing, right? So I think housing is a great example of what I was sort of asking about with a lag effect, right? So you mentioned how high mortgage rates have gotten housing prices really haven't come down that much, though. I mean, I think on an annual basis, they're still down maybe like 1% or something like that. So we have had more than a doubling in the cost of a mortgage, and we really haven't seen any relief on the price side yet.
Right.
How do we avoid that? I mean, it's supposed to be a mathematical relationship, just almost sort of like the bond market, right? Higher rates, lower prices. So I'm really interested because you said residential housing may be borrowing here, and then I want to get into multifamily and commercial real estate in a minute. But first off, just how do we have such a dramatic increase in the cost of mortgages and not pay a price on the price side?
Well, it's widely recognized that existing homes there just aren't on the market. There isn't a supply of existing homes because a lot of people actually got locked into their homes by refinancing at record low mortgage rates, and the thought of moving to another house with a mortgage of 7 to 8% is daunting. And so a lot of people say, you know what, let's just redecorate the house. Let's just stay here. We don't have to go anywhere. And so there's a real shortage of that kind of inventory. And so the builders have suddenly been finding that despite high mortgage rates, they can actually build and find buyers. Maybe they have to throw in some extras to get the deal done. But there is a demand.
Sorry to interrupt, but just to be clear, some of those extras are lower mortgages, right? Like 4 to 5% mortgages.
That's right. That's right. That's correct. That's correct. But whatever's going on, we are seeing signs that new home sales and housing starts are bottoming, and that the rolling recession, which really started in the single-family housing market, may be bottoming. It doesn't mean that things are about to improve dramatically.
Okay. So in addition, obviously, to retail, right? Whether there's another shoe to drop or not, right? I mean, you're right. Transactions are kind of at historic lows right now because nobody who's sitting on a 3% mortgage wants to sell, right? But there's a lot of buyers that don't want to buy today either because it's the worst of both worlds, right? You get the high price and the high mortgage, right?
Yep.
So you did said that you're much less optimistic about multifamily and commercial real estate. I have talked to a number of housing analysts on this channel recently who have sort of added validation to your comments there that inventory is coming on in a lot of these hot markets at kind of the absolute worst time.
Yep.
right? So it probably will make things worse there. My point is if we see, a housing freeze on the residential side, which is kind of what we're seeing, right?
Yep.
Where transactions aren't happening. Obviously, transactions are likely to be impaired in the multifamily and in the
Mhm.
commercial real estate side as well with your outlook.
That's right.
There's a multiplier effect. Housing is a big contributor to the economy,
It is.
right? And there's a multiplier effect because when a house gets built, it employs
Yep.
all sorts of people, right?
Sure.
So I'm just curious. I mean, it seems like the
Yep.
economy may take a pretty material hit from this cooling off of the
Well,
housing market across all those sectors.
the housing recession has been with us since the beginning of last year in the single family housing area, and that employs a lot more people than multifamily. And yet we have construction employment at an all-time record high. So how's that happening? And obviously, if you've got construction at all-time record high, there's a multiplier effect of all those construction workers who have jobs, are getting paid pretty well, and there's a lot of demand for their services, and so they have purchasing power. Well, the answer is that we've got the government spending a lot on infrastructure. There's a lot of onshoring going on because of the tensions between China and the United States, because of the supply disruptions that occurred because of the pandemic. There's a lot of construction of the non-residential facilities, particularly for manufacturing. Construction of manufacturing facilities has been off the charts. I had to recalibrate my charts to kind of keep them in there.
Mm-hmm.
So I'm watching the construction employment data. I mean, you're not going to see construction employment data keep making record highs. So you're going to see it take a dive if, in fact, broadly speaking, the construction industry is in trouble. And right now, that's just not the way it's adding up.
Okay. So on the construction side, you're right. From what I understand, there's been a lot of government stimulus coming in here, right? You mentioned the deficit spending earlier in the conversation here. It's been really interesting because we've had the Fed and the banks pushing hard on the brakes on the economy, and yet we've had the administration and Congress pushing hard on the gas, right, with the stimulus. I'd love to get your general thoughts on that, but specific to the point you're making there, I have heard from some recent guests that I have interviewed, and I haven't had the time to really confirm this with my own research, but that a lot of the approved spending for the Inflation Reduction Act and whatnot that's been flooding into the economy this year is sort of, I don't know if it's expiring or coming up for approval, but basically there's a chance that could diminish materially from here unless there's strong bipartisan support to continue it.
Yeah, I mean, I look at the monthly outlays data that the Treasury puts out, and honestly, I'm not saying that spending has even really started in a major way. The major reason that outlays have been increasing of late has been we provided inflation adjustments for the Social Security, and interest costs have been going up. So the government spending, it takes time for the government to spend money. It's easy for them to allocate a lot of it, but to actually spend it is a whole different issue. So that's actually still ahead of us, and a lot of what we're seeing is actually been in the onshoring, and some of that may represent some tax incentives that are provided by the governments, which aren't showing up in outlays, but are showing up in reduced revenues. But all in all, the government spending is still ahead of us. I just don't see it in the monthly data that the Treasury puts out. I'm not seeing the outlays excluding entitlements and excluding interest and excluding defense shooting up. It's just not in the data, and that's where you'd expect to see it if, in fact, all of this spending that's been allocated is actually happening.
Okay, so just to restate that, for the folks that are saying, hey, we may start seeing the fiscal spigot turn off, you're saying, I'm not even sure it's been fully turned on yet.
That's what I'm saying, yes.
Okay.
It's not that I'm not sure. I'm not seeing it in the data. I'm very, like the Fed, I'm very data dependent.
Right, which is what makes you such a great guest, Ed. So thanks for this. So let me ask you this sort of high level question then, which is, maybe this is a good time to get into the consumer side of the equation. But if rates are back to the pre-abnormal highs, so the old normal highs, right? And I think you mentioned, like, I can't remember what range you said, but like 2020
4 to 5%.
Right, but the years you used were like 2003 to
2007.
2007.
Yeah,
Yeah. Okay, one thing that's really different between now and then is the debt levels,
correct.
right? Both at the federal level and just at the
Yeah.
household level, right? And so we have a lot more debt to apply these higher interest rates to, right? So
Mhm.
so higher interest rates have a higher gravitational force, you could say, than they did before,
Sure.
right? But also, incomes have not really kept pace, certainly haven't grown. Neither the national income, neither the GDP or personal incomes have grown anywhere near as fast as the debt levels, whether it's the national debt or the total credit outstanding, right? And even though you made a comment, which I believe is true, which is that real incomes are now experiencing positive growth again.
Yeah,
That's a
real wages.
relatively recent event, and
Last
the
year.
charts I've seen show that, like, I think maybe like 2 or 3 months they've been positive. Before then, it was like 25 consecutive months of negative real interest rate growth. So my question is if the cost of capital has gone up so much and it's being applied to so much more debt, like, where is the income coming from to make it okay for the system to continue,
Well,
as if everything's all right?
yeah, just as a side note, keep in mind that the government's increased interest expense is increased interest income to those who have government securities, money market funds, treasury bills, etc. And so there is actually, it is an outlay by the government, and it's a stimulative outlay when you think about it for consumers. Their personal interest income is at an all-time record high. So is their dividend income, by the way. But corporate America in the second quarter generated at an annual rate $3 trillion of cash flow, all-time record high. It's really tied what we had a couple of quarters ago, but it's basically an all-time record high. So corporations are still generating a tremendous amount of cash. They've got depreciation allowances that shelter a lot of their income from taxation. And so they're actually generating a tremendous amount of liquidity. And many of them refinanced at record low interest rates back in 2020 to 2023. So the lagged effect that you typically see when interest rates go up and corporations have to refinance, that's longer than usual. And it doesn't all happen in one shot. It happens over time. And we'll see how interest rates play out. But even if they stay here, I think, as I said before, we did live with these interest rates before. The stock market did rally and move higher with these interest rates before, and I think it could do it again. There's also still a tremendous amount of liquidity left over from the pandemic. This notion that consumers accumulated a bunch of excess savings that they've now all spent and they're about to slam on the brakes. I don't buy that. Demand deposits are basically at an all-time record high in the M2 monetary aggregate. There's still a lot of liquidity in the system. And, just because people got windfalls doesn't mean that they spent it all. They could very well have put it in their portfolios. And what we're seeing is that the net worth of the household sector rose to an all-time record high of $157 trillion during the second quarter. And half of that is held by baby boomers who are retiring. And guess what they're doing? They're spending some of their retirement money, which might also explain why the consumer's doing so well. My friends are baby boomers. I'm still working for a living. Many of them are retiring, and they go out to restaurants all the time. They're traveling. Of course, they stop by to take care of their health at healthcare facilities. But that explains why we've got record employment in the healthcare industry, why we've got record employment in the hospitality industry. There's a lot of moving parts here that need to be factored in, and I'm trying to do that.
Okay, and that's a great point that you bring up there, which is that a material part of the government's outlay right now that's contributing to the deficit is payments to debt payments that are finding their way to holders of US Treasuries,
Right.
which in many ways are a lot of US citizens, right,
Yep.
who are now finally enjoying a return on their fixed income, right, which they weren't getting at all before. Yeah, it's a big deal. So, you say that the consumer is not doing so bad, and that may be a good reason why. Now, I would underscore the consumer is maybe not doing so bad on average, right?
Yeah, I was exactly going to say that, because I always get feedback saying, well, you live in a rarefied world, maybe your friends are doing well, but nobody else is. That's absolutely correct. I mean, you can't really generalize about the consumers. There are those who are not doing well. Those are living paycheck to paycheck. We know that. But we're looking at the overall economy. We're looking at the overall impact of the economy on earnings in the stock market, and from that kind of top-down view, the consumer still is spending.
All right, and I do want to comment, Ed, that the last time you were on, we actually spent some time at the end of the discussion opining upon the growing wealth gap in this country, the toxicity of that. It's something that concerns you very much. But I'm not going to rehash that discussion because we've already had it, and folks can go watch that older video if they want to get your detailed thoughts on that. All right. So you mentioned, corporate America is doing well in the sense that we have profit levels, total profit levels kind of back up to where they've been at record highs.
Well, cash flow, very important. I mean, profits are also near record highs. As a matter of fact, the S&P 500 earnings per share will probably hit a record high in the third quarter. We're in the middle. We're just starting the earnings season, and I think when all the data comes in, we're going to find that the S&P 500 earn a record amount during the third quarter. This is something we've been predicting for a year, when others have been predicting that it's going to crash.
Right, and I want to get in a moment to your outlook for the rest of the year, because I believe from your recent writings, you expect, as actually several recent guests on this channel have warned, but projected that the S&P could actually end the year relatively strongly. Right. Mm-hmm. So we'll get to that in just a minute, but for corporate America, I'm going to say on average, right? It's probably doing quite well for the reasons you mentioned, but I am curious, going back to the lag effect, how concerned you are, or your level of concern, for the fact that if rates stay this high, if we stay higher for longer here, that as debt maturities begin to catch up with these companies, right? You mentioned that they did what you would expect. When rates were cheap, they borrowed as much as they could, right? So they've sort of pushed off the day of reckoning more than normal, but rates stay high here, it eventually will come. And it's certainly going to hit the more over leveraged companies, first, right? And so the zombie fleet, right? I mean, is that something that you're worried about actually materially impacting?
Yeah, look, I'm worried about the same issues that the bears and the pessimists are worried about. It just I tend to also point out that I try to be balanced about it and say, look, it's not like everything's going wrong here. I'm constantly getting emails from accounts and others, give me a litany of what can go wrong here, and I welcome that, because it kind of keeps me sharp. I think I know the pessimistic story pretty well. If you wanted to spend an hour and told me, okay, I'd just bury everybody in pessimism, I could actually tell the story pretty well. But I'm not sure the pessimists could tell my story, because they don't focus on what's actually going right.
Great. And Ed, I'm building up to a question here, which is, what do the bears have wrong here? So I very much want you to keep, swinging at these pitches the way you are, and bringing the data that you're bringing. Sure. Real quick, just back to the bond market, the recent rise in yields. You listed a number of factors, right? Things like the Fitch debt downgrade, right? The tightening by the Fed and the banks, the rising supply of treasuries. Yeah. But none of that is like super new news, right? I think those are all things the market knew had been coming for months, at least, right? So why is it now? Why is the bond memo seem to be only getting the memo now?
Right. It's a very good question. I think that the bond market basically has been focusing on the Fed, and when the Fed started raising interest rates aggressively, the bond investors along the way pushed bond yields up along with short-term interest rates. And then last summer, we started to see that bond yields weren't going up as quickly as the Fed was raising interest rates. The yield curve inverted, in other words. And of course, the pessimists said that was going to lead to a recession, and they could still be right. I'm not saying they've been totally wrong about that. And as a matter of fact, inverted yield curves have a very good history of predicting recessions. Why? Because what they predicted is that if the Fed keeps raising interest rates, something will break in the financial system, we'll get a credit crunch, and we'll get a recession. Well, the inverted yield curve was right this time again. We had a banking crisis back in March, but the Fed played whack-a-mole, got its hammer out and provided tremendous amount of liquidity to the banking system. And so we haven't had a credit crunch, haven't had a recession. And then this past summer, a few things happened. One is that all of a sudden everybody was patting me on the back, say, you said there wasn't going to be a recession, and so far that looks right, and that kind of got me a little nervous here because my contrary instincts came out, and I actually started to raise my concerns about a recession as I was getting complimented for having stayed the course on the idea that the economy wasn't going to fall into recession. As you know, at the beginning of the year, that was kind of a widespread talk. So when the bond market came to that same conclusion, hey, wait a second, we've inverted here. We're buying bonds at 4% when the 2-year is 5%. Maybe that doesn't really make much sense if we're not going to get a financial crisis, a credit crunch, and a recession. And then, of course, we had the Fitch downgrade, which I think really was a big deal. I think it really reminded everybody that, hey, this deficit situation really is out of control. And by the way, the Treasury announced that sure enough, they were going to up the ante in how much they were going to have to raise in the Treasury market. And I think ever since then, supply has become a very serious issue. And I think the bond market is just trying to find a yield level that will clear the marketplace. And I think it's going to be right around where we are, 4.5% to 5%. But as you know, there are people talking about it spiking up above 5%, going to 6%. And if that were to happen, let's do this again, and you'll probably get a more pessimistic view for me. But I'm thinking that inflation's moderating, and that's going to help. I'm thinking the economy's going to show some slowing without going into recession, and that's going to help to stabilize the bond market. And the fact that yields are extremely attractive relative to an inflation rate that right now has been coming down and may very well go still lower.
So I haven't seen them super recently, but some of the last charts I saw on stocks versus bonds is that the equity premium was like at the lowest it's been in like 25 years, right? And bonds are only getting more attractive from a return standpoint.
Correct.
Right? Now you're somewhat sanguine still on stocks in the short term, it sounds like. Let's talk about that for a bit.
Term. Yeah.
Okay, short and long term. Okay, great. But we have this great alternative right now, right? I mean, we've just gone through this multi-year era of TINA, right, where there was no alternative. In fact, a long period of time where there was no alternative. And all of a sudden, there's a really attractive alternative right now, but you still see stocks, churning higher from here. So explain that.
Well, there's again, as we all know, it's head spinning. It's a head spinning world right now. There's so many moving parts. But with regards to this stocks versus bonds issue, first of all, bonds have to stabilize. I mean, nobody, wants to buy a bond yield at 4.8%. If they look at the past few weeks and say, my God, this thing could be at 5.5%, then what's the rush? And meanwhile, you're actually being paid in money market funds not to do anything in the bond market, right? You're being paid 5%. So what's the rush to jump into bonds here when they've the velocity at which they've been the yields have been increasing has been staggering and unprecedented. And everybody keeps talking about, this is a unprecedented 3-year debacle in the bond market. So I think that's one of the issues. I think maybe when the bond yield finally settles down and people have a confidence that it could stay here for a while, then if it's in the 4 to 5% range, you're right, it could pose a challenge for the stock market. But the stock market obviously is driven by two variables, earnings and valuation. I started out my career, by the way, as an economist on Wall Street. And then over time, I took on both roles as a strategist and economist. I wanted to be a strategist because it's an easy job. All you have to do is predict the earnings and the valuation multiple. Getting them right is the tricky part, but it's only two variables. So let's talk about those for a second. On the earnings side, again, I think it's going to be at an all-time record high for the S&P 500 in the third quarter. We've been talking about $225 per share this year for earnings. The analysts are at 220 right now. They tend to be too low going into earnings seasons, so they could very well revise that number up. But 220 is close enough to 225, especially compared to some of the Wall Street's pessimists who've been talking about $180 to $200 for this year. So far, so good. But, got to keep looking ahead. Looking backwards is at your successes or failures is only useful if you learn from them and use that to your advantage for thinking about the future. In the future, I think that 2024 will be a good year for earnings again, a very good year, $250 a share in my outlook. So that's a plus for the S&P 500. The negative is the competition from money market funds, from bond yields, and the fact that the valuation multiple is still pretty high. Last I looked, there's about 18.5 for the S&P 500 using forward earnings. But as we know, the mega cap 8. I mean, some like to focus on the Magnificent Seven. I like to include Netflix in there. I watch a lot of Netflix, so I put it in there. And the mega cap 8 now account for about 25% of the S&P 500. These companies are not going to go away. They're going to continue to account for a significant share of the market cap of the S&P 500. And that being the case, I think we have to factor in that they do have high valuation multiples. They're highly prized for all sorts of good reasons. For one thing, they don't have a lot of debt, and investors want to buy companies that don't have a lot of debt. So I think the companies that have less debt are going to have higher valuation multiples, and some of them happen to account for a lot of market cap of the S&P 500.
Okay. And if we do have time, I do want to ask you your thoughts on the AI part of the Magnificent Seven.
Yeah.
You've written you've written recently on the fact that everybody's making semiconductors right now.
Yeah.
I'm curious to hear where you think that's going to go, especially because it powers so much of the
Right.
general indices. Back to bonds just for a second. So you're right. People are looking at the yields going up and saying, well, they look really attractive, but I don't want to necessarily catch the falling knife, right? I don't want to
Right.
buy them at 4.8 if they're going to be 6 at some point in
Right.
the future, right? But trees don't grow to the sky. At some point in time, we're going to hit the plateau, and then maybe
Mm-hmm.
things will come down, and we'll talk about that in a second too. But bonds, it looks like, are due for an unprecedented treasury bonds, an unprecedented third year of declines.
Correct.
Right? You've probably seen the same stats I have, right?
Yeah.
Like since the beginning of records in the 1700s, we've never had 3 years of decline. Do you think that we will have a fourth year of decline, or are we in a truly different scenario right now, or may this be a really wonderful bond buying opportunity because we've had this unprecedented third year, highly unlikely we're going to have a fourth year, and there may be other factors as well that you're looking forward to that you think could support bonds?
Well, I think there's two alternative scenarios, and I think in both of cases, the bond yield declines. In my happy one, the inflation rate comes down. Consumers keep spending, but at a slower pace. So some of the anxiety that the economy is too strong dissipates. The deficit is still a problem, but at these kind of interest rate levels, there's enough demand to balance supply and demand. And in that scenario, the Fed could very well deliver on the summary of economic projections that the FOMC recently put out, in which they said that if things go according to script, we should be able to lower the Fed funds rate a couple of times next year. And so that suggests that if you buy bonds here in that kind of scenario, you might regret not having bought them at 5% if they spike up like that. As you said, the 30 is already there. But they should work out. At least you would probably earn the coupon, and you might actually get some capital gains on them. So no, in that scenario, I don't think that there's going to be a third year of a debacle in the bond market within the context of that scenario. The other scenario is an ugly one. And it's one that Ray Dalio has been talking about recently. The hedge fund community, I think, is very excited about it because they're all short the bonds. And the idea is that we are in the early stages of a debt crisis, and that with the government deficits increasing, with the interest component of the government outlays increasing, that we're going to find that it's going to take 5.5–6% bond yields to get supply and demand in sync. And then at those kind of levels, I'm not convinced, as are the bears. They're not convinced either that the economy can withstand that kind of much higher level of bond yields. I mean, certainly the commercial mortgage market would continue to get annihilated, and that could spread out to other credit issues. We had a banking crisis in March, and this could very well come back in this debt crisis scenario. So what happens there, of course, is private credit demands evaporate. You have crowding out, which is a term we haven't really used for quite some time, but the government crowds out the private sector, and you get a really bad recession. You get a credit crunch or a recession. You get deflation, and in that scenario, we may not own enough high quality bonds. I don't know that I'd want junk bonds in that scenario, but government bonds, even though there's plenty of supply of them, might be the only game in town. So I'm not sure. I guess there probably is some scenario in which, the bond yield goes to 6, 7, 8, 9, 10%. I think that scenario would require that inflation makes a surprising comeback, that the Fed just caves in, that suddenly everything's falling apart, so they stop quantitative tightening, quick switch back to QE and lower interest rates. It said, we even if we're risking inflation making a comeback, we can't have this whole debt crisis implode the financial system. So that's a real outlier. It's not where I am. It's not even where the debt crisis bears are, in my opinion. It seems like what they're saying is we just got way too much Treasury securities. Rates are going to go up to a level at which the rest of the economy can't deal with it. I think we've talked before that I coined the phrase bond vigilantes back in the early 80s.
Right.
And they're back. They kind of were asleep for a while because inflation really wasn't much of a problem. And the bond vigilantes' job is to take law and order into their own hands in the capital markets and the credit markets if they feel that fiscal and monetary policy makers are out of control. And I think the bond vigilantes, my guess is they feel pretty comfortable with what the Fed's been doing. They've been laser focused on bringing inflation down and raising interest rates, and that's obviously hurt bond investors. But at some point, that will be good for the bond investors. It's the fiscal side, I think, that's got them really riled up, and that's where we are seeing this recent spike in the rates. Because up until the summer, we were kind of between 3 and 4%, kind of between 3.5% and 4%, and that seemed to be the new normal, or the return to levels that the economy could live with. And then bang, out of the blue, we got this spike up in the yields to currently 4.8%.
All right. Ed, I get often criticized for asking questions that are too long, and I'm going to be very validly criticized now because I'm looking at the time. We don't have a ton of time left, so I'm trying to munge a couple questions together.
Yeah, sure. I can also keep my answers shorter.
No, your answers are just great. So I want to ask you what you think the Fed's going to do from here. I've been talking to some people recently who feel pretty confident that even though they're guiding the market, there's probably one more bullet left in the chamber. They're not going to fire it, that they're really done. in your answer, would love to get a stronger sense of your expectations on inflation. Sounds like you think they are going to become well managed, but I'll let you describe that. And in your answer, one more thing, which is, how long can the fiscal spending continue at its current rate, right? As a percentage of GDP, it is at an exceptional high right now. And you can't have fiscal spending like that eventually without creating more inflation, right? It begins to become contrary to the efforts of the Fed. So if your answer, if you could try to tackle all those together.
Well, I think the Fed is done. I think they've got to be concerned about what they're seeing going on in the bond market. I mean, monetary tightening isn't just a function of where the federal funds rate is. It's obviously at a restrictive level. They've said that they think it's restrictive. There's no reason to do another 50 basis points when the bond market's been tightening by 70 basis points since the last meeting. So the bond market's done a lot of the tightening for them, additional tightening. And meanwhile, contributing to the rebound in bond yields, of course, has been the underlying quantitative tightening, where they've been letting their balance sheet run off as the securities mature. And by the way, the commercial banks have been doing exactly the same thing, because one of the things that happens when you go from QE to QT is you actually depress deposits in the commercial banking system. And on top of that, of course, people are putting their money in money market funds rather than deposits to a certain extent. So the banks too are letting their assets mature. And so that doesn't leave too many buyers other than individuals, household investors, institutional investors, and foreign investors. So I think the Fed is done. I think inflation is going to continue to moderate. We continue to see, we saw the latest price indexes from prices paid indexes for manufacturers and for service companies remain low. That's come back down to where they were basically before the pandemic, before the inflation surge. So I'm encouraged by that. I think quits have come down, suggesting that the wage inflation should moderate. People quit for a higher wage, and so that coming down is a healthy development. The whole key here to a happy scenario is that inflation continues to moderate and that the economy slows somewhat.
All right. So if inflation somehow ends up resurging here,
we're in trouble.
Back on the channel, and you may have a different outlook for things.
Oh yeah, I mean, everybody would have a different outlook.
Okay,
but there are people who are still, I guess, in that camp who think that it's just going to stall out here and it's not going to continue to come down. What was the second part of your question?
Well, how long can the fiscal spending continue at these elevated levels before it really starts contributing to more inflation?
I'm reminded of the generic answer to a question like that is, I don't know, but we're going to find out.
Okay. So you think we're going to keep doing it until we hit it?
There's nobody in Washington that really cares at all about fiscal responsibility. Ever since the pandemic, both Republicans and Democrats have been on a spending spree. They've all seemed to have bought into modern monetary theory that and modern monetary theory isn't monetary. It's not modern. It's not a theory. It's just the notion that the government could spend, as much as it likes in order to keep full employment, and they can use tax policy to beat down inflation wherever it pops up. I mean, the thing is just ludicrous, but it's. I think that's where the bond vigilantes come in here. Is if we don't see inflation continue to moderate in the face of the widening deficits, then I think the bond vigilantes will basically push yields up to levels that create a crisis and hopefully lead to a political solution. But there's so much partisanship in Washington for them to agree on. So how do you actually narrow the deficit? Do you cut outlays? Well, the liberals aren't going to be happy with that. Or do you increase taxes? Well, the conservatives aren't going to be happy with that. So it's going to take some grand compromise here to get the deficit outlook to be somewhat more manageable than it is right now, and factoring in that as we've been saying, the real problem here is interest expense just mounting.
So Ed, if I may, one of the big reasons why I really appreciate you and your willingness to come on this channel is, you know, I'm always on the lookout. I would say a lot of the people that I interview on this channel, I'm not selecting them for this, but the data that they're looking at gives them a more pessimistic view of where things are going. So people are always telling me, "Hey, look, bring in a bull, right?" And I would put you in the bullish camp on a relative basis of the people that I interview, but it's because you bring the data and you say, this is the data that is causing me not necessarily to be bullish, but to be more optimistic than maybe most folks do. And there are people out there who are bulls, but for them it's a philosophy, and in many cases they're I think can be validly accused of being like water carriers for either the administration or for financial advertisers or whatnot. I don't see you in any way like that. I think that you can point to a lot of things in this system here that you don't like, period. They may be what they are, but you don't necessarily like them the way that a lot of our viewers get enraged about a lot of other things that are going on. But I also get the sense that if your data changes, you will absolutely change your outlook, right? So I just have very much what this channel is about is bringing on, you know, intelligent people to talk about how they interpret the data. And what's so important and what makes a market is intelligent people can interpret the same data differently, right? And I appreciate that your view, while it is less common than the folks on this channel, it is no less important to be looking through the lens of an analyst like yourself. So thank you for doing all that. In wrapping all this up, you've already given a good nod to a lot of this, but to get down to brass tacks, because this is a wealth building channel and investors are, you know, looking for ideas to consider and things to look into. It seems to me that your market outlook for the rest of this year and going into 2024 is pretty optimistic right now. I think your latest numbers say that the S&P you see, you know, could go to 4,600 or so by the end of the year, and then higher for next year for reasons that you've already largely shared. I think I heard you say you think bonds probably likely going to have an up year next year, you know, probabilistically. So at this point, are there any assets that you think you're particularly encouraged by, and vice versa? Are there any assets that you would not touch right now, given your market outlook?
Well, look, the energy sector still looks very attractive to me. The energy companies, a result of climate activism, particularly at the political level, have gotten the message that they can cut back on their capital spending and just generate a lot of profits and a lot of cash with an oil price that's relatively high, partly because we're not drilling as much. So the result is they're using their cash flow to pay investors. Dividends have been very strong. Buybacks have been very strong. So this is a sector that should continue to work. Some people may be philosophically against investing here because of the climate issue, but from a straightforward return perspective, these are very profitable companies that likely will remain profitable. The large cap financials look very strong to me. They are in good financial position. I think there's going to be a wave of M&A activity in the smaller banks, regional bank area, and that's what will keep those stocks from tanking as they deal with some of their loan loss problems. They're going to have to consolidate and become bigger banks or be acquired by bigger banks. Love technology. I mean, they try to sell the mega cap Adolf last year, and what the managements did is demonstrated that all they had to do was fire some people and cut back some, pie in the sky capital spending on metaverses and things like that. And wow, their earnings were phenomenal. And so they are, real players. As we've been writing, everybody's getting into the semiconductor business. In some ways, my thinking is any company that really budgets a good chunk of their capital spending on technology is a technology company. They're not making technology; they're using technology to become more efficient, more productive. And I think from that perspective, most companies are technology companies. They have to do it. If they don't do it, they're just going to be left behind. So technology still makes a lot of sense to me. But I would leave it there for now as overweights.
All right. Thank you so much, Ed. And I really appreciate you being so specific and so direct. That's exactly what we hope our guest experts do here, is give people, individual asset classes to go off and research after they've listened to these discussions. All right. Well, Ed, if you can hang with me for 1 second, because I want to give you the last word. I just want to share some resources for viewers here real quickly. Folks, just a reminder that Wealthion's fall conference on October 21st is coming up super fast now, folks. It's less than 2 weeks away. The early bird price just expired this past weekend. That's the lowest discount that we offer on these tickets. Hopefully, most of you locked in your tickets then. If you didn't and are kicking yourself, don't worry. We're still offering our last chance to save discount price for this week before the tickets go up to full price. So if you missed the early bird, go lock in your tickets now at that last chance to save price. To go do that, just go to wealthion.com/conference. And if you're an alumnus of one of our previous conferences, check your email. You should have the code from me that'll give you an additional 15% discount off of that. And just in wrapping up here, Ed gave us, great outlook about the future. A lot of good direction of different asset classes to go investigate. If you are, a regular investor who doesn't have a lot of time, spends most of their focus on their family, on their job, et cetera, which I'm guessing covers about 98% of the people watching this video, I just want to reinforce our general message that we deliver every week, that you should consider working under the guidance of a good professional financial advisor in making your portfolio allocation and management decisions. If you've got a good one who's doing that for you, who also takes into account all the macro issues that Ed and I discussed here, great, stick with them. But if you don't have one, or if you'd like a second opinion from one who does, consider talking to one of the financial advisors endorsed by Wealthion. These are the ones who see with me on this channel week after week after week. To set up one of those consultations, just go to wealthion.com, fill out the short form there. Only takes a couple of seconds to fill out the form. These consultations are totally free. There's no commitment to work with these guys. It's just a free public service they offer to help as many people as possible position as prudently as possible today. If you've enjoyed having Ed on this program, would like to see him come back on soon, please let him know and encourage him by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. All right, Ed, for people that have really enjoyed this whole interview, maybe this is the first time they've listened to you, and they're interested in learning more about you and your work, where should they go?
Well, we about a year ago created a product for individual investors, and it's reasonably priced, and it's really almost a daily, and it really focuses on understanding how the macroeconomic data influences the markets and how to anticipate that. So it's YardeniQuickTakes.com. www.YardeniQuickTakes.com, YARDENI, and you know how to spell quick takes.
Great. And Ed, when we edit this, we'll overlay on the screen the URL so folks know exactly where to go. Perfect. Folks, we'll also have a link down in the description too. So if you just want to click on that and go there. I am a subscriber to the Quick Takes. They're great. I was prepared with all these questions for Ed because I read those Quick Takes all throughout the week. Ed, it's been really wonderful. Thank you so much for your time. Really hope you can come back on the program again soon.
It'll be my pleasure. Thank you.
All right. Everyone else, thanks so much for watching.